Welcome to Tech Confidential's Behind the Money. I'm Mary Kathleen Flynn, and I'm here with Chris Sacca talking about angel investing and the economy. But before we get into all that, let's just talk a little bit about your portfolio. You left Google, what, about a year ago?
I left in December.
In December. And you've been full-time investing, advising ever since. Tell us about some of the companies you're working with.
Yeah, well, before I left Google, I actually had a couple investments. One was in PhotoBucket, which we sold to News Corp, and another one was in Twitter. And I found I was spending more and more time and getting more excited about working with these small companies again. And so when the opportunity to leave Google came up and actually do this full time, I got pretty excited about it. So since then, I've been involved in 17 companies. I'm invested in about a third of them, but in all of them, I'm a professional advisor. So I work with these companies day in and out, kind of crafting strategy, building front pages, user experiences, and then helping them through corporate events, anything from hiring to distribution deals to raising money and selling the company.
You mentioned PhotoBucket, and you've had a couple of other exits, if I remember correctly, too. So tell us your successes.
Yeah, PhotoBucket was a great success. I was really excited about that company, and those guys just relentlessly focused on user experience and built something over 60 million active users, and so it was an obvious target for acquisition. I've had small companies, too. One was Octomatic. It was a Y Combinator company that had built a front end to eBay, and we were able to sell that earlier last year to a Canadian company called Live Current Media. Those guys are really happy up there. And then I just sold a company called Omnisio to Google. There's three guys who built some really cool video mashup tools and annotation tools. And I think it was the first acquisition that YouTube had ever announced they'd done. So really fun, sponsored by the YouTube group.
I've also noticed that you seem to co-invest with some of the same people over and over again, like the Betaworks guys. Tell us what it's like to work with them and why you like investing with the same people.
Yeah, well, I think there's an entire kind of tier of guys who are investing in early stage stuff. And it's not necessarily angels. It's people who are professional accelerators, advisors, and the economics of how we're doing deals are very different from a traditional venture fund. What's happened is the cost of building a company in the software and web space has come down by kind of 15x since 98, 99. And so these investments don't fit the profile of traditional VCs anymore. If you're going to move the needle for a VC who's got a $500 million fund, then you have to be looking at a $200–300 million exit to be meaningful to them and to their limited partners. We're building companies that take tens of thousands of dollars of investment up front and then sell for maybe $10 to $20 to $30 million. And so not very interesting for traditional VCs, but for those of us participating in this early stage market, really interesting. And I think so what we're seeing is folks like Betaworks, folks like Josh Koppelman at First Round Capital, Ron Conway and his Baseline Fund, Jeff Clavier, Mike Maples. There's a bunch of us operating in this tier. And so we end up doing co-investments just by fact that we're all kind of looking at the same stuff.
And Union Square Ventures I would put in that same category, too.
Sure. I think they do a little bit later stage stuff, too.
So let's talk about the economy. It's on everybody's mind. How is it changing your investments, your strategy, how you look at startups, and what you advise them?
Yeah, a few things. I think a lot of the casual angels have fallen out of the market. These are guys who are kind of looking at their stock account, with logging into Morgan Stanley or Schwab, and they had a little bit of extra play money, and I think a lot of that went away in the last month, and it's going to continue to go away. I don't think this market has settled out just yet. So the casual angels have fallen aside. The venture market is still strong because those funds were raised as 10-year funds, and their LPs can't redeem that money back out. So in contrast to a private equity or a hedge fund, those guys can't take that money back out. And so the VCs still have all that money. And they're actually under pressure to get it deployed, because if they don't get it deployed, they can't go raise another fund and continue to kind of milk all these fees up there. And that's how VCs get rich in this environment right now. So the VC environment is still strong. I think there's a little bit of shell shock still from what's happened in the market. So there won't be a lot of deals getting done right now. That said, I like to play in the end of the market that's really small, really lean. 3 kids literally in a room coding from where they live in, building stuff that actually, I try and focus on stuff that's in the stream of commerce somewhere, that's touching money, where companies are actually writing checks to my startups. And so we've got companies that are either cash flow positive now or tipping into cash flow positive, and that's a really nice place to be in an environment like this.
I keep talking to entrepreneurs who say that they are operating very leanly and that they started their business model that way. I mean, can they cut costs any further? I mean, is there sort of one piece of advice you can leave us with before you go for entrepreneurs out there?
Yeah, I think there's been this big push by a lot of investors, kind of gurus in the space, to go raise as much money as you can and prepare for the nuclear winter. And I think that it does make sense to go ahead and have resources on hand and not be too lean and check that bank account balance. But at the same time, if you raise too much money, you're actually setting the bar of success really high for your company. Because if you take $5 million on 15, you're a $20 million post now, your VCs really aren't going to let you sell that for less than 60. And the number of people who can acquire you for $60 million is a lot fewer than the number of people who can acquire you for $10 or $20 million. And so what I fear are entrepreneurs pushing themselves into these binary outcomes where they either succeed in a big way or fail and get zero. And I like to really keep teams small, keep that burn small, keep the fundraising small, so that entrepreneurs are in control of their destiny, can choose their outcomes, and define success for themselves and not have a VC impose it on them.
All right, so think small.
Yeah, definitely think small, and then and keep control so that you can define what a positive outcome is. You know, a VC may not be intrigued by a $15 million sale, but when you see a couple of 22-year-olds holding checks for $3 million each, they have big smiles on their faces.
All right, great. Well, thank you, Chris Sacca, angel investor and company advisor, and thank you for watching Tech Confidential's Behind the Money. I'm Mary Kathleen Flynn.